Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, the market seemed to be poised for a positive start for third consecutive session, tracking global cues. SGX Nifty indicating a positive start, maybe a mild one coming in for the broader index with a gain of around 29 points on Tuesday. US stocks, they traded mixed, or rather just say ended mixed, as market awaited more clarity on US debt talks. Asian benchmarks managed to eke out small gains after the productive US debt talks narrative. Also, FIIs at this point of time, they bought shares worth around 922 odd crore, and in terms of DIIs, they've too purchased shares to an extent of around 604 odd crore. In terms of bunch of earnings that we'll be tracking this morning will include the likes of NMDC, Biocon, Dixon Technologies, Amaraja Batteries, JSW Energy, Fortis Healthcare, Varroc Engineering, Bajaj Electricals, Ashok Leyland. These are going to be some of the companies which will be reporting in their numbers today, and a bunch of F&O Qs out there also for us this morning. And let's actually get on to what's actually made it to the F&O ban list, securities that have moved into it, securities that have been added into the ban period: Indiabull Housing Finance, L&T Finance Holdings and Manapurna Finance. These are the securities which have been added to the F&O ban, and in terms of those who have been removed from the ban includes Aditya Birla Fashions and Retail, Balrampur Chini, Delta Corp, Gujarat Narmada Valley Fertilizer and Chemicals. But let us going and discuss some stocks and strategies with Sudeep Shah, Deputy Vice President, Head of Technicals and Derivatives at SBI Securities out there. Good morning there.
Good morning, Nickey.
All right, I'm going to start off by asking you about the trend that you think is playing out for Nifty. Do you think it has reversed the short-term downfall trend by gaining for second consecutive session yesterday? And now with that, what is the strategy you think market participants can look into?
See, what's happened is that after a big rally in the last 15 days, there were a couple of days where we saw some kind of sideways action or consolidation. But if you see, last couple of days, the action has picked up once again. And now this is courtesy IT stocks. So we have seen some kind of a reversal in the IT index. IT index has closed above its 17th April gap down, that 1,000-point fall. That entire area of the last 1.5 months has been negated, and now the trend is shifting on the upside. And so is what the stocks momentum in the stocks and the chart patterns are also suggesting the same. So with banking right now already having rallied in the last month and too fast, it was a too fast rally. So with that, now what we feel is that the action is shifting somewhat in the IT space. Large caps as well as mid caps, even if they rise 3-4% from here, that will support the Nifty and at least give some time for the banking space to consolidate and then be ready for the next up move. So I feel all in all, it is going well for the markets. From a Nifty standpoint, 18,250 now will act as a strong support going forward. And till this holds, we can see levels of 18,500 odd on the index. From the bank Nifty perspective, 43,400, 43,500 will act as a strong support. Until this holds, the trend will firmly be on the upside.
All right, Sudeep, you said 18,500 level. Is that what the level that the market participants can be looking into for today's session? Do you expect the markets to cross over that 18,500 level?
No, this is positional, what I am just sharing. But from an intraday perspective, 18,280, 18,250 will be the supports, and on the upside, 18,430 will be the first resistance. Now this zone will be critical. So we need to cross 18,430 for a move up to 18,500, 530. So it will be in a range, and we should take every level as it comes. So on crossover of 18,430, then the next resistance, then the next target should be 18,500 on the Nifty.
All right, FIs have been selling bank Nifty futures and buying Nifty futures, indicating the strength of the latter. What's the strategy between Nifty and bank Nifty that you suggest to the viewers right now?
See, FIIs have been selling bank Nifty, but that number also is not too higher. And while we have seen some action pick up in the IT space, and that is why we are seeing some kind of buying in Nifty futures. So Bank Nifty sell number, I will not read too much into it, because the overall trend of Bank Nifty, if you see the daily, weekly, monthly charts, that is all firmly on the upside. So it is better that we look for a dip and use that support or a dip to go long and then ride the overall rally. So rather than just trying to play for 1 to 3% on the downside from a corrective perspective, I feel the viewers and the traders should be eyeing themselves from a positional perspective and add at lower levels and on dips.
All right, so buy on dips typically or add on dips is the strategy that is playing out right now. But we are going to be tracing in bunch of stocks in just a jiffy before we get to know the 3 profitable ideas from Sudeep for our viewers out there. Sudeep, come in on this one. 3 profitable ideas for our viewers.
See, the first one would be LTI Mindtree. Now, we've seen after a fall up to 4,200, 4,300, the stock has sharply reversed. And in the last few days, we've seen some absolutely some fantastic action in these mid-cap IT names. The stock is now firmly above all its moving averages, and we've seen a consolidation breakout in this counter. So I feel from the current levels, the stock can be bought for a target of 51.50 and a stop loss of 48.90 on the downside. The second stock would be IndusInd Bank. Now, generally what happens is that when the bank Nifty moves, it is we always expect the ICICI's excess of the world to move. But what has happened with IndusInd Bank? It has sharply and steadily moved up to 1230, 1240, which is the upper end of the resistance, is now ready for a breakout. It has now even broken out of its consolidation, which was happening in the last few months. So I feel the stock is quite ready from a perspective of breaking out for the next 7-8% on the upside, and this can be bought with a 1210 stop loss and a 1320 target. The third one would be Cummins India. Now, this stock in the last 15 days has consolidated in a range of 3.5%. And now it is showing signs of a breakout at higher levels. And it is while we've seen from the same sector, we have seen Larsen, Siemens, they are not performing, but we have seen an outperformance from Cummins. So I feel that from the current levels, the stock can be bought with a stop loss of 1610 and a target of 1740 on the upside.
All right, Sudeep, I'm going to touch base with you in just a bit with the IT stocks because they've been outperforming for a couple of 4 consecutive sessions. And even if you talk about the ADR performance overnight for Wipro and Infosys, they've been up by more than 2.5%, probably indicating of yet again a positive start coming in for these defensive names out there. But earnings first, BPCL, Shree Cement and HEG, these are the companies which are reported in numbers. There is an initiation report by MOSL on Kajaria Ceramics amongst other. But let's first address BPCL numbers and the profits that have come in. Top line performance is up by 8%, 1,33,419 crore. That was the number that the company has reported as compared to an estimate of around 1,28,000 crore figure. EBITDA was up by 85% at a number of 11,084 crore. Now, Street was working with an estimate of around 5,600 odd crore. Margins have come in at 9% as compared to 5.73%, and the profitability has shot up more than 150% in on YOY basis for this one. Now, what typically Morgan Stanley has to say about this one is maintain the overweight rating for BPCL, and the target price is to an extent of 390 per share. Right now, the stock is quoting around that 360, 65 odd levels, indicating some amount of upside coming in from those levels. The core earning beat estimate is account of strong refinery margins of around $20 per barrel out there. The Morgan Stanley report also expects strong margin to continue and the oil product demand and the crude discounts to support the recovery for BPCL out there. Shree Cement is another one where it's reported in numbers. Revenue is up by 16%, and if you talk about the EBITDA, is down by 3% for this one. Margins have come in at 17% as compared to 21%, a bit of miss. Net profitability is taken a knock by 20%, and there is also a dividend announcement to an extent of 55 per share overall for the financial year. Costs probably has paid out because of the higher merchant power generation. Realization to an extent is higher than estimate due to power sales. But overall, if you look at the numbers, not really encouraging set of numbers coming in for Shree Cement, but BPCL is where we'd like to see the reaction. HEG was another one on our list, and Kajaria Ceramics is where the initiation report is coming on. But let's address markets opening for you right now. 18,350 mark, well above that, with gains of 0.25% out there. So gains coming in for the markets. Bulls are clearly holding on to the fort. And talk about Bank Nifty index, because that's where we're seeing some amount of strength also creeping in thus far in all the sessions that we've seen for the markets and the bull run that has continued. But in today's session, a bit of underperformance as compared to Nifty. Nifty is seeing gains of around more than 0.3%. Bank Nifty on the other side is trading flat, has opened flat with gains of minuscule gains of around 0.1% out there, but comfortably holding above that 43,920 level. It's just consolidating along, around that all-time high levels. And the breakout above that remains to be important, at least for Bank Nifty and the bull run per se. Talk about the sectoral indices that we have, mid cap and small cap also before that, but also talk about the advances and the declines ratio. Mid cap index first, with gains of around 0.5% out there. So outperformance coming in from the mid cap index. Small cap index too, we're seeing that gains coming in 0.25% on that one. Advance and declines. Advances, market breadth right now is in favor of advances. 39 stocks advancing versus 11 stocks right now which are on the declining side. IT is up in green. It's holding with gains of around more than 0.1% out there. It's, I think, the fourth or the fifth consecutive session that IT has been holding up. And so is the outperformance coming in from the auto index overall. Let's see how metal index is stacking up for you with gains of more than 1.5%, actually close to 2%. So it's shining in green out there for you. Pharma index too, the other defensive pack out there with gains of around 0.25%. FMCG is doing well with gains of around more than 0.1% out there. So entire sectoral indices right now seems to be a basket of green out there. Realty index flat momentum but with positive bias thus far has been holding up in green. A bit of profit booking in the last two sessions, but today again we're seeing some amount of traction building in. Consumption story remains intact and we're seeing gains to an extent of more than 0.3% out there. Advances and declines at this point of time, market breadth is further skewed in the favor of advances. 38 advances as against 11 declines on the index right now. Nifty is right now hit a high of 380 and it's consolidating well above that 350 mark. Let's address the top gainers and the top losers on the list out there just to see where the market breadth is right now. Adani Enterprises and Adani Ports. Well, Adani Group of companies have yet again made it to the list. BPCL, after reporting the solid set of numbers, just as we indicated, is shining in green, topping the list out there. And Britannia, Bajaj Finance and Infosys. These are some of the other top gainers that we have overall on the list. In terms of the top losers that we have on the list right now, something also like Maruti Suzuki and Bajaj Finserv is doing well when it comes to the Nifty top gainers. In terms of the top losers, we are sitting with losses coming in for Kotak Mahindra Bank, Coal India, Apollo Hospitals for that matter, and some of the other top losers that we have is Cipla, DV's Lab and Bajaj Auto. So clearly some amount of discrepancy which is playing out for auto names out there. And also look at the IT companies, something in the like of Wipro or Infosys for that matter. Before we also check the reaction for Shree Cement, because that's another one which reported in the numbers, right? Shree Cement, there was a bit of miss coming in. Nifty 50, once a Nifty 50 company out there, now is moved out of the list. Overall, not a good show coming in for the cement manufacturers. The ability to go ahead and pass on that price hikes is something which is important for these players right now. But Shree Cement right now is doing well with gains of around 2%. A bit of better than estimate as compared to the realization. On the realization front, that's on account of the power sales and the gains thus far that have been coming from that one. HEG, that was once a multi-bagger out there, but has been languishing at the bottom end both HEG and Graphite India. But HEG is the one which is reported in numbers. Net profitability is down by more than 22%. The stock is down and out with losses of around 5%. Revenue is down by 8.5%. EBITDA is down by 21%, and the margins have shrunk at 20% as compared to 23.3% in the corresponding quarter of the in the previous year. Kajaria Ceramics. Now, MOSL has initiated a coverage on that one with a buy rating and the target price of 1,490. Right now, you're not seeing any amount of momentum building in on that one. The stock is currently trading at 1,250 odd levels, so significant upside for Kajaria Ceramics. Now, the target is based on a 1 year forward EPS of around 40 times. That's the valuation that the stock is demanding right now. This compares to a 35 times average 1 year forward PE over the last 5 years. So bit of valuation upside, but the factors that are supporting the buy rating include a 30% earnings CAGR from a period of FY23 to 25, strong return ratios, ROE, ROCE, ROIC, all of them are expected to only improve in FY25, and there is a healthy balance sheet. If you talk about the maintenance, the premium multiples are expected to continue here on. Also, I would like to point out, the QSR industry is doing well. You talk about Devyani International and something like a Jubilant Foodworks. All of them, for the last couple of days, we're seeing some amount of action building in on those names out there. Macquarie has come out with a report on the consumer sector overall, and it said that packaged food performance overall in the quarter 4 was a positive surprise. The consumery trend was not that great in tea, where consumer downgrades weighed on the volumes. Having said that, the Macquarie report says that the premium segment overall has outperformed the mass end segments. There's a gradual uptick which is seen in terms of the volume profile. The margins are likely to remain stable in FY24, and the rural trend, the rural demand seems to be bottoming out. That was a common thread in the outlook which was shared by the companies, and the volume growth commentary was optimistic across the players. In fact, most of the companies were hopeful of moving to high single digit levels in FY24, where there's a sharper volume growth recovery. That does require further reduction coming in on the input cost pressures. But a margin commentary overall was a little bit of cautious coming in by these players, with companies' need for higher media spend. So that's a bit coming in. Macquarie note on the consumer trend overall. Sudeep, I'm going to come on, I'm going to ask you this one question before we move our discussion further to the fundamental side. Talk about the IT stocks, because they've been doing well, and in today's session also the index has been outperforming, or rather just say adding on to the gains that it already has built on to. What's your assessment, and what do you like from the overall pack?
While we speak about the IT index, it's very important to know that yesterday's session the index has managed to cross its 200 DMA once again, and today it is adding up to that gains. So the trend is changing. Now this move yesterday and the continuation today has been after 12 to 14 sessions of a consolidation that we have witnessed in the IT space. Secondly, this move which has happened today, with that we have even negated the sell candle that was a big candle from 29,000 to 27,000 or 2,000 point fall candle in 2 days. Now the 13th April was the day. So we have now managed to cross above that level also. So I feel that the tide is kind of changing for the IT space, and although it may not move still like the banking names like which had moved in the last 2 months, but now this index will lend some kind of stability to Nifty, and that is what we want. That's what I feel that would be expected out of IT stocks, and within that the top picks would be LTI Mindtree from the mid cap space, which we already discussed. Now there's one more from the large cap name is HCL Tech. Now this stock has, from a results perspective, fundamental perspective, it has always
levels,
given good.
Sudeep, if you could just give levels out there for the HCL, because we're completely running out of time to address the fundamental side of the story.
Yeah, so HCL Tech, if we see the level wise, I guess the breakout has already happened and should be added on dips. 1100 would be the stop loss, and I feel on the upside the targets could be 1160, 1170 in the next few sessions to come.
All right, Sudeep, thank you so much for taking out the time and speaking to us this morning. But it's that time of the show where we talk about the fundamental size, and there is enough and more to be spoken about. There's this fear of missing out, playing out from the investor community, whether the uprun is completely gone out of steam, and there is more. Probably the question that most of the investor community asked right now is, there is more steam coming in for the rally, at least when it comes to the bull run. To address all this and more, we've been joined by Prakash, Diwan, the director at Almount Capital Management. Good morning there.
Good morning, Nickey. Good to be on your show.
Pleasure. You've seen a big run coming in for the markets day after day. There's some amount of consolidation that took place, and again, the bull run is back. I think the discussion that we were having yesterday, Prakash, when we were before offline, before we kind of charted into the territory of the sectors that we don't want to talk about. But the little understanding that I gathered at this point of time was, of course, we are seeing more momentum to come in for the index coming in. And where do you see, which are the sectors and the pockets which you think will further add to the steam, to the existing rally for the markets right now?
That's a very interesting question, because that's exactly what most investors are confounded with. You see the market go up, start testing or getting close to all-time highs, and your portfolio really hasn't sparkled up as much, given the fact that you decided to stay out of the market. So that FOMO kind of deepens when markets do this. So it's important to understand that there's no need to panic. There's no need to kind of get desperate with your allocations at this point. But watch out for sectors which are likely to contribute to the next leg of the rally. Now, in this leg, we've seen what's happening typically is the way banking surged, then pause. Probably Bank Nifty hits a new high, but that's more anecdotal. You've seen IT come into its reckoning on the last 2-3 sessions, and probably auto will take a backseat now. So there's very clear sector rotation, Nickey, which is leading to this Nifty being very range bound but still on its way up. I think if you look at cycles, capital goods, which started last year, is still promising. Maybe the best part of the returns have been made, but there's still a long way to go. I think FMCG, selectively consumer, non-staple discretionary is another area where money will be spent, and to some extent, I think defense is already played out. So you would need to book profits, get into something which is more likely to do well. Cement, for example, there's nothing which is I heard you talk about Shree Cement and the kind of contribution that cement has been making across the board in terms of mid cap, large cap businesses doing well. I think cement is a play that people could look at. So there's lots that's happening in terms of sector rotation. You'll have to start locking into sectors which are yet to perform, but that's where the money will be.
So, okay, we're going to get on to that discussion in just a bit, of the sectors that you think would be more money-making ideas out there. But we're seeing significant amount of outperformance coming in from the capital goods sector. Siemens, I was just checking in last time, 7% down and out with the kind of demerger that they announced in. Despite that, the stock has rallied 20%. And in comparison to that, ABB, although it's not like completely similar profiles out there, or 40-45% gains out there. So what's the story which is playing out behind the entire capital goods sector? And you think there is more of upside within this space right now?
Oh, yes. So, the seeds of the capital goods cycle playing up positively were sown last year. And this is when, the full impact of PLIs announced by the government started translating into the manufacturing sector. Our exports were always led by gems and jewelry or IT services and, things which were not necessarily manufacturing oriented. But the moment manufacturing came to the fore and this Atmanirbhar Bharat kind of started filling in the gaps in terms of import substitution for a lot of heavy machinery, a lot of industrial, a lot of defense equipment, that's exactly where cap goods came into play. Now, what's moved up in cap goods? It's not that cap goods is a very broad, all-encompassing kind of a term that includes everything that is spent on as part of capital expenditure, right? But an equipment that is used to make further products is what cap goods is. It's simply defined as. And from that perspective, you see the lines of ABB, Timken, Thermax, Siemens. They've CG, Crompton Greaves. they've done so well because the order booking has been so good, the realizations have been so proud, and they've got pricing power, Nickey. The difference this time, what's worked for them, you asked the question, some of them have done 40, 50, 60% in a year. The reason is they've not just got a book that's very robust, but then they've also got margins to back that up because they've got pricing power. Everybody wants to get those orders executed. Companies, from sugar mills to paper mills, to shoe manufacturers, to toy manufacturers are placing orders and are saying, take the money, but get us the equipment, get us the machinery quickly. So when that happens, you start getting pricing power into your system. And that's what's happened this time. Is it good to go? I think yes, because, organically, we've just started off on this long journey where we are heading to be a manufacturing hub. But the nature of equipment, the nature of, cap goods will probably change as the order booking moves into a second level this thing. So you'll have more packaging equipment, more material handling equipment. Those are things which will start working. So smaller companies will also benefit. That will percolate down to logistics, CNF agents, as I said, material handling, forklift manufacturers, conveyor belt manufacturers. There's a host of things that will probably happen.
Prakash, within the broader markets have outperformed overall the larger counterparts, and with that perspective, we've also thrown in some logistic name out there. Do you think there is a hidden small cap gem that one can look at and probably analyze and take their bets accordingly? What looks attractive from the small cap space overall at this point of time?
So finally it has to boil down to what to do with stocks. Basis this story that this narrative that is emerging. I was talking about consumer discretionary non-staple category, which is, I'll tell you about a small cap there. It's about 1,600 crores whereabouts market cap. It's a company called Stovecraft. Now, why I've chosen this is because this represents the new growth engine for India, which is part consumption domestically and part, all of it manufactured within the country. Yeah? So there's no reliance on Chinese imports or cheap products to kind of come in and get pricing to be manageable. Stovecraft has its own manufacturing facility, which are state of the art. They've been investing into this. The beauty about this is this company sells kitchen appliances, small kitchen appliances, right from, ovens and hobs and toasters and things like that, and a lot of utensils. They have a brand called Pigeon. They have a brand called Gilma, which is more on the hobs and the kitchen top and the chimneys of what go into modular kitchens. And then they've also got Black & Decker, which is anyways an electric appliances business company that we all know of. Now, what Stovecraft has done is they've been utilizing these 3 years post the IPO, 2-3 years, in expanding the distribution reach and the manufacturing side. So getting both those legs completely in place. And that's finally something which has happened. Last year, they took a hit on the margins, on the profitability, precisely because the metal prices went up. They use a lot of steel in all their products, and that's where they got hit. But if they come back to 12%, 11, 12%, 13% kind of margins again, which was very normal for them. And mind you, even in the pandemic, they managed to grow the revenue because of the kind of, push that or the pull that was created with people being at home and wanting to do a lot of stuff in-house. Now, if you look at the kind of businesses that they've got into, there is very clear that last year they clocked 1,200 crores of revenue. This year they've already close to that in the first 9 months itself. I think going forward, they'll probably end up doing a run rate of close to about 2,000 crores plus and grow incrementally from there on. And with the kind of margins that I'm talking about, there's no reason why the company should be available at just a 1,600 crore market cap. So these are kind of small cap businesses which are out of favor right now. But as consumption grows, as efficiencies come in, as distribution kind of starts getting the brand out there in your face, there's no reason why things don't look up. So I'm saying FMCG, QSR, consumption, all of these are themes that you do, and everybody, all Indian promoters have sized up the opportunity that our market offers, whether it's import substitution or export. So that's a story that one will look at.
Prakash, I'm going to chat about QSR industry, but I'm not sure how much of time we'll have that. But before that, I'd want to squeeze in one last question probably that I have in mind is for the Adani Group of companies, because that's where the significant up move has come in from. There's a bit of delight out there after the ruling that has come through in terms of the findings with regards to that Hindenburg report. I'd want to understand because they, trading around that upper circuit limit, be it Adani Ports, be it, probably Adani Enterprises at this point of time. What's your assessment overall on Adani Group of stocks? And within the QSR space, what do you like?
Okay, let me get the Adani question out of the way because it's a very simple. It's good to see the revival of these stocks and confidence come back, because people who don't own the stock but who watch the movement also take the key takeaway is that okay, things are normalizing. There wasn't anything which was suspicious or beyond the regulatory this thing, and whatever was done has been explained or understood, right? So that's where this thing. Fundamentally, ports, Adani Ports and Ambuja probably stand out as very clear, strong balance sheets with a strong P&L potential. So, you could look at that at some level, but they've run up quite a bit. Especially ports has run up so much. I mean, I've been talking about ports at about $500 and it's already closer to 800. So, you'll have to wait for the valuations to get softer in this because they were under-owned. Their ramp-up has been very good. On your question on QSR, we do look at businesses where it's like, and that's one of the reasons why pizzas come to our mind, because that's something which is very accessible and which comes to us. But there's one business within the QSR space where we end up going to the premises, and that's Barbecue Nation. And the reason why I like this particular business model, Nickey, is that it's a very strong niche that is used to cater to in every city. And they have just grown that niche in multiple locations because it's very location specific. The number of stores that they've opened is commendable. They did a mistake by going overboard in terms of expansion of the menu and the locations, and that kind of pulled them back. And that's why the stock's gone from 1270 or wherever to 625, 630. So it offers great value. You may not see profitability and the P multiples look very stretched because the depreciation takes away the EPS accretion. But that will change at some point in time as the depreciation tapers off. And the best part is that every footfall means an assured billing of a certain amount, depending on what the person opts for, a full vegetarian or a non-vegetarian option. So there's no guesswork. Somebody could come and spend $500, somebody could spend $1,500. Here, everybody would have to pay that much. So it's a revenue model that's kind of self-generating in that sense. But yeah, it'll take some time for it to get profitable across the board because it's in an investment and growth phase. But from the QSR space, on the long term, I think BBQ Nation is definitely something which can pay off.
All right. Those are the bets coming in from the QSR space. I'm definitely not adding to the revenue out there for that space per se. But Prakash, thank you so much for taking out the time and speaking to us this morning. It was indeed a pleasure chatting with you.
Yes. Thank you. Thank you so much.
All right, with this is a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below and follow us on the link at the bottom of your screen for rest of the updates. Stay tuned into moneycontrol.com and Moneycontrol app.